What's going on, guys? It's your boy. It's your boy, Jaymoney. Yeah, like no one calls you that. Stop it. A few people do. No. So, okay, I've been promising videos for a while. I know, got a lot of stuff going on. I've been promising some free content. Started trading earlier this year. Turns out I was pretty good at it. Not gonna lie. Not gonna toot my own horn. But recently left my job to trade full time, and everyone's like, "What the hell is this guy doing? Like, what's going on? Can you give us some tips? Can you explain it?" So, I've started a new channel. It's called Jaymoney. This is where you're gonna see all of my finance videos at. Okay, so let's get started. This is going to be Options Trading 101. So I'm assuming if you're here, you know a little bit about how stocks work. Maybe you know some technical analysis. Maybe you want to get into options. But this is going to be an options kind of like, starter course for you. I do got some paid content I'm working on, but it's a while out. So the stuff that I give away for free, if you get value out of it, I'd appreciate it if you share it. Subscribe, like, comment, give me some feedback. And I will try my best to keep it informative. And, we can, look, I'm going to tell you something. This shit ain't easy, okay? When you see a nice YouTube video put together, you better like that shit, because it's hard. I got a green screen behind me. I got a microphone here. I had to do a PowerPoint presentation. You know how long it's been since I used PowerPoint? I remember last PowerPoint I had on my computer was PowerPoint 1998. That's how long it's been, okay? So, but I think I did pretty good. I think you're going to like it. So here we go. Options Trading 101. So, what are options? Essentially, options are derivatives of stocks. Now, what's a derivative? A derivative means that it derives its value from something else. Okay? It's not worth anything on its own. It derives its value from something else. It points to something else for value. And for options are a derivative of stocks. Okay? So if there were no stocks, there could be no options. Alright? So knowing that, you now know that options move when stocks move. Alright? But in the simplest form, they're basically insurance policies. Okay? What do I mean by that? They basically protect you against price movements of the underlying stock based on which one you choose. Alright? So, there's two types of options. Okay? We're going to go over one in this video, and then we're going to go over the other one in the other video. But understand, it doesn't matter what strategy you've heard of, whatever they've called it, iron butterfly, iron condor, vertical spread, calendar spread, kangaroo jack, whatever options you've heard of, they all can be assembled, I guess you could say, by two types of options, and that's calls and puts. Alright? So a call is the right but not the obligation to buy 100 shares of stock at a specified price. The strike price before a specified date, the expiration date. Alright? Option contracts are always for 100 shares. The strike price is the agreed upon transaction price. Expiration date is the time you have to exercise the option. Alright? And for puts, it's pretty much the same info, but instead of the right to buy, it's the right but not the obligation to sell 100 shares of stock at a specified strike price before a specified date. And the same thing. 100 shares per contract. Strike price is the agreed upon transaction price. The expiration date is the time you have to exercise the option. Okay? Alright. So, let's look at calls. This example. Say it's a fictional company, XYZ. Its current stock price is at $10. Alright? You've done your homework on XYZ, and you believe in the next 30 days that it's going to go to $12, which would be a $2 increase, right? So it's going to go to 12 bucks. But instead of buying 100 shares of XYZ, which would cost you $1,000, 10 times 100 is 1,000. So instead of buying that, you buy a 30-day call option. Now we're going to assume it's January 1st. I just picked a month that I knew had 30 days in it. January, okay? So you're going to buy a 30-day option on January 1st. You're going to buy a call option with the strike price of $10 for $1 a piece. You pay the seller a $1 premium. Now, the price that you pay the seller to be able to control his 100 shares, remember, an options contract is 100 shares. So that $1 premium is times 100. All right? So it's $100. All right? That is what the price you pay him to be able to do that. So $1 times 100 shares is $100. You buy the option. Now, this is how most options will look on a brokerage platform, give or take, or on an options chain. We'll go over that in other videos. But you basically have the strike price, you have the expiration date, you have what kind of option it is, and then you have the number of shares in control. All right, so on January 25th, remember it's January, you got 5 days left. The price is indeed $12. Good job. You did a good job, okay? It goes to $12, okay? You've got two options at this point. You've got two choices. I put you had two options, and then I was like, wait a minute, they're going to think their option doubled. Like, no, it didn't double. You got the one option, but you got two choices on how to deal with it. So that's why I put you got options. All right, so you can trade the option contract to someone else for a profit. So if you remember, when we started this video, options are a derivative of stock. So when the option price goes up and you have the right kind of option, the stock price goes up, the option price is going to go up, right? So your option price, you might have paid $100 for it, but now that the stock is at $12, it might be worth $250. It might be worth $300. It's depending on a lot of different factors, and we'll get to those factors in later videos, okay? But just understand that your options are worth more if the stock moves in your favor within a specified period of time, okay? So you could trade it to someone else for a profit. You could just say, hey, I got this option here to buy XYZ at $10. You want it, and they'll pay you for it, and they will exercise or whatever. Or you could exercise it yourself. So say you were to exercise. We're gonna hone in on option B. You exercise the contract and you purchase the shares at $10. So $10 times 100 is $1,000. If you chose option B and you have $1,000 in your account because you need money to actually buy the shares, you can't just be like, yeah, I want them, and then you can't pay for them. Your option will then turn into 100 shares of XYZ. Okay, you following me? All right, so you've got 100 shares of XYZ, and they're now worth $1,200 because the stock went up to $12. Great, fantastic. You turn right around the next day, the next minute, the next second. As soon as they're giving you can sell them back the next second. Okay, if you're that quick, it doesn't matter. You don't have to hold them. Okay, you turn around and sell them on the open market for $12. Now you take a $1,200 credit for that. Your profit from all this is $100. Huh? What'd you say? Now hold on now. Hold on. I bought the shares at $10 and the price went up to $12, but I only get $100 profit. Like what's going on? Okay, your profit is not $200, not quite, and here's why. All right, you remember that call option you bought for $100? That one right there, a couple screens ago. When you chose to exercise that option, the person you bought the option from got to keep the $100 premium for taking the risk of their shares being called away from them. All right, let me repeat that. When you chose to exercise the option, the person you bought the option from, the option seller, you were the buyer, they were the seller, they chose to, you gave them a premium, $100 premium to be able to do that. Okay, you didn't get to do that for free. So you have to subtract that $100 cost from your profit. So think of it like this. You're talking about a premium. What do you pay premiums for in your life? Insurance, right? Life insurance, boat insurance, car insurance, home insurance, health insurance. You pay premiums. If you are never sick and you never use your health insurance, you don't get to call them up and be like, hey, I ain't been sick in a few years. Let me get that, that money back from that health insurance. It doesn't work that way. If you don't get into an accident or get any tickets all year, you don't get to call your insurance company and say, hey, I know that I was paying you these premiums every month to cover me if I got into an accident, but guess what? I didn't have an accident, so can I have that back? Doesn't work that way, obviously. No, they get to keep that money, because had you been in an accident, you would have been covered, right? So that's what the premium's for. You paid $100 for the right to buy these shares from this person. No matter what the price was in the future, you could buy the shares for $10. You had the option to do that before the 30th of January. All right? So, this is the breakdown. You bought the options contract for $100, right there. You bought 100 shares of XYZ from this seller for $1,000. You sold 100 shares at the market for $12 a piece, getting the $1,200 back. Minus 100 minus 100 was minus 1,100 plus 1,200 left you with a $100 profit. All right, that makes sense to everybody. If it doesn't, just rewind the video, bring it back. You'll understand it. I think I made it pretty clear though. So you're probably thinking now, well, why the hell did I buy the option? If I was gonna just get $100, I should have just bought the stock, right? I could have just bought the stock at the beginning with my $1,000, and then sold it for $1,200. I would have had a $200 profit. Why did I even bother buying the option? I'm going to tell you why. For one, it was less money up front. All right, your option only cost you $100. Had you had to go out and buy an equal amount of shares, it would have cost you $1,000 to buy 100 shares. But that $100 allowed you to control a $1,000 asset. You got to control someone else's asset for 30 days. Now think about that. Someone else has already spent money on this. They gave you the option to control it. They couldn't do anything with it until it expired or you chose what to do with your option, okay? So maybe you know, you were in between paydays or whatever, and you didn't have $1,000. Maybe you had $500, but you're going to have $1,000 in 2 weeks when the option, you know, was getting close to expire, and you could make a decision on whether to buy the stock. But you had $100. And you wanted to get in on the trade. You did the research, man. This baby's going $12. I know it. I feel it in my bones. I'm going to buy this option for $100 so that I'm in the game. So when the move happens, if it happens in 2 weeks, you're out of luck because you're not in the game. But if it happens and you've got an option, well, you got some money coming to you, right? Okay. So the only other reason is you can only lose your $100 if you were wrong. All right? Now think about this. A myriad of things, the myriad of outcomes could have happened had you paid $1,000 and bought 100 shares of stock, okay? This is some of the outcomes. The stock could have went to $9. You would have lost $100. You had 100 shares, $9. Would have went to $8, $200, $7, $300. It could have theoretically went to $0. Could have went to $0. You could have lost everything. Now listen, if you, I'm sorry, if you thought that the stock was going to go to $12 and it went to $0, you got bigger problems than, I'm sorry, this is funny. You got bigger problems than, I mean, you should go seek professional help, okay? The stock essentially went to $0 because the company went bankrupt. So what did you see in your analysis, whether it was technical or fundamental, what did you see that made you think it was going to go up? It's funny. It can happen. Okay, it can happen. It rarely does, but a stock can go to $0. It happens. You guys remember Hertz Rental from earlier this year? They were like, hey, we're filing bankruptcy. We ain't got shit. Come take the cars, the tires, the floor mats. We ain't got none of that. And people the stock went to like 80 cents. And people started buying it back up, and it went to like $2, and then it crashed. So a stock can go to $0, theoretically, okay? So you could lose everything. But because you bought the option, your losses are capped, all right? None of that stuff happens to you. You were able to avoid all that because if the price never went above $10, the most you could lose would be the $100 you paid for the option. Now, why is that? Because say at expiration on January 30th, the price of the stock is $9.99. All right? Would you go to the person you bought this option from and say, hey, I want to buy those shares now for $10? No. Why would you do that? You could buy them for a penny cheaper on the open market. Now, yeah, it's just a penny times 100, which is, you know, $1. But you just, I mean, we're all trying to save money. Why would you ever pay more for something than you have to? So you would never pay more than the $10 for the you would never pay more than the market. I'm sorry, for the option if it were to be exercised. Now, if the option is not exercised and you get to January 30th and the price is $9.99, your option expires worthless. He still gets to keep that $100, and that is how they make money. That's how I make money. He still gets to keep that $100 because he gave you all this time. He gave you all this time for that stock to go from $10, you know, get above $10. It never did. He made a bet when he sold it to you that, okay, the price is not going to be over $10. You made a bet that I think it's going to $12. So you paid him for that option to be able to buy it from him at the current price on the 1st of January if it went up. It didn't go up. The deal's done. He gets to keep the $100, but all you lost was $100. All right? So, you essentially purchased insurance against you being wrong and going broke. Because all of this stuff right here could have happened on the end. Any of these things right here on the corner could have happened to you. All right? But they didn't. And had they did, had the stock went to $8 and you wouldn't have lost $200 because you only paid $100 for the option. The option's worthless now. You just walk away. You don't have to do anything with it. It's worthless. It disappears from your account. But if the stock had went to $20, had it went to $100 in this time, it would suck for that guy, but he would still have to sell you those shares for $10 because that is what you paid him the $100 to be able to do. Okay? So, if it increased, went to infinity, went to 1,000, it doesn't matter. It doesn't matter. Hey, bruh, I'm going to need them shares for $10 like we talked about. He's got to give them to you. All right? I'm not saying you got to call somebody and be like, hey, bro, your broker takes care of all that. You don't even know who it is. You know, but that's a different thing. That's called assignment, exercise and assignment. We'll get into it. It's way, way down the line. You guys got to know a lot more before then, okay? But, so, that's going to be all for this video. It was a little longer than I thought. We're not going to do puts. It's going to be in the next video. You probably can figure out how it works by then. And then we'll move on from there and we'll get into the Greeks of options trading, the theta, gamma, vega, delta, rho. We'll get into all those. And, you know, I'll try to arrange it to where you can stack all these learnings on top of one another so that when you're done watching this, you have a really solid foundation of how options work. And then we'll go into complex option strategies, but you've got to understand the basics first, because you can make a lot of money with options, as I have, or you can lose a lot of money in options, as I have. So it's really important that you understand how it all fits together. Okay. So subscribe if you want to see more content like this. Comment if you have any questions, things I could have explained better, things I might have left out. You know, I've watched other videos of people explaining things, so I tried to keep mine really simple. But I've been doing this for a good little amount of time, so I understand it backwards and forwards. I have to get my mind back into when I didn't understand and how I would have appreciated someone explaining it to me. So that's how I'm trying to explain it to you guys, if that makes any sense. Comment on any other related finance material you'd like me to cover. I'm really good with finance. I'm not trying to brag. I am trying to brag. Let me brag. Wait, let me brag. This house I'm in, bought it 4.5 years ago. I paid it off in 4.5 years. It was a 30-year mortgage. In one of my videos, I'm going to explain to you how I did that. I'm explaining to you how I did that. I'm going to do a video on interest rates and credit cards and, you know, basically anything finance related. You're going to find it on this channel. And I hope you enjoy the content. So give me a thumbs up, like, subscribe, all that, so YouTube can show my video to other people. And I will see you in the next video. Peace.